Hi, this is Mad. Today, Mad is going to explore the success secrets and common traits of billionaires who became rich through finance and investing. If you're ready, let's get started. Benjamin Graham is a teacher of Warren Buffett. Benjamin Graham is considered the father of modern investment and is especially known for his value investing strategy. Graham argued that the intrinsic values of stocks could be different from market prices, and he developed an investment approach that saw this difference as an opportunity. He advocates for investors to focus on the true value of stocks regardless of market fluctuations. One of Benjamin Graham's most important principles is the concept of margin of safety. This concept encourages investors to reduce risks by buying stocks at a price lower than their true value. According to Graham, the market can sometimes be irrational and push stock prices below their true values. Investors who take advantage of this opportunity can achieve high returns with low risk. However, patience and resistance to market fluctuations are required for this strategy to be successful. Another important contribution of Graham is his advice to investors to stay away from speculation. He viewed examining companies' financial statements and understanding their true values as a much safer and sustainable investment method compared to trading based on short-term price movements. Charlie Munger is best known in the investment world as Warren Buffett's right-hand man and vice chairman of Berkshire Hathaway. However, Munger has achieved financial success with his unique investment philosophy and disciplined approach, and has played a significant role in Buffett's success. His investment strategies are built on analytical thinking, patience, and making long-term investments. Munger is a loyal advocate of value investing approach. This strategy requires focusing on companies' intrinsic values regardless of temporary market fluctuations. Munger's investment philosophy is based on deep analysis and a solid knowledge base. One of his greatest talents is simplifying complex problems and patiently waiting for opportunities. Rather than acting impatiently, he prefers long-term thinking and only investing in companies he truly believes in. Munger further advanced this strategy by instilling the idea in Buffett: it is more logical to buy good companies at fair prices than to buy bad companies at cheap prices. Munger argued that investing in low-quality companies just because they are cheap is not efficient in the long run. Instead, he believed that investing in quality companies with strong business models, management, and sustainable competitive advantages would be more profitable. Buffett embraced this view and changed his investment strategy accordingly. As a result, Berkshire Hathaway focused on acquiring large and quality companies. It invested in giants like Coca-Cola, American Express, and Apple. Warren Buffett is one of the biggest names in the investment world and is known as the Oracle of Omaha. His investment philosophy is based on long-term and value-oriented investment. Buffett invests in companies with low prices but strong potential and holds these investments for a long time. With this strategy, he has accumulated a huge fortune over time, regardless of market fluctuations. He also attaches great importance to dividend investments and advises his investors to be patient. According to Buffett's philosophy, investment is buying a stock and holding it forever. When Buffett was asked, "What would you do if you learned that there would be a big crisis today?" he said, "I would continue to do what I did yesterday. Crises always happen." One of Peter Lynch's distinguishing characteristics is that he keeps his investment strategy simple and finds investment opportunities through products and services encountered in everyday life. According to him, individual investors have the advantage of capturing opportunities that large fund managers cannot see, because the innovations they observe as consumers can show the growth potential of companies. Lynch, who attaches importance to being cautious, patient, and disciplined in his investment strategies, states that it is risky to invest in a company without analyzing its fundamental indicators. Stating that the secret of his success is to think long-term and to analyze the balance sheets and income statements of companies correctly, Lynch advises investors not to be afraid of market fluctuations, but instead to focus on companies that will gain value in the long term. Philip Fisher is a pioneering figure known for long-term growth investing in the investment world. Fisher has advocated for long-term investment in companies with high growth potential. His investment philosophy focuses on the quality of companies' products, management team, and innovation power. According to Fisher, an investor should consider not only the financial statements, but also the company's management culture and future growth potential. A key aspect of Fisher's approach is to believe in a company's long-term potential and wait patiently. He argues that by investing early in companies with growth potential, significant profits can be achieved over the years. John Paulson, especially known in the financial world for the large profits he made by predicting the 2007 housing market crisis in advance. During the subprime mortgage crisis, Paulson realized that the financial system had become overly dependent on risky mortgage securities and took a large short position against it, achieving historic success. According to his predictions, the U.S. housing market was in a bubble and its burst was inevitable. When the housing market collapsed in 2007, Paulson's fund made nearly $15 billion, propelling him onto the global financial stage. The main factor behind John Paulson's success was his ability to skillfully analyze market excesses and imbalances. Ray Dalio is known as one of the most prominent investors in the global financial world and the founder of Bridgewater Associates. One of the most important elements in Dalio's investment strategy is portfolio diversification. This strategy suggests investing in different asset classes to minimize investment risk. According to Dalio, market uncertainties are always present, and therefore, diversifying investments among different assets is the most effective way to mitigate risk. He has used this method to minimize uncertainty in the markets and has coined it the Holy Grail. Additionally, he has developed an investment strategy called All-Weather Fund, which aims to be successful in all market conditions. Disciplined investment strategies, portfolio diversification, and an approach based on macroeconomic analysis have played a critical role in Ray Dalio's success. Dalio has emphasized that long-term thinking is the most important strategy in investment. George Soros. It is known for its approach called reflexivity theory by Soros. This theory claims that financial markets operate in a unique cycle and that investors' expectations shape the markets. In short, investors' beliefs and actions influence the markets, thus creating market cycles. Utilizing this theory, Soros took advantage of many opportunities and made significant profits with high-risk moves. Soros has a profound understanding of market psychology. By analyzing the behaviors of market participants, he engages in short-term speculation and achieves significant profits. When making investment decisions, he relies not only on economic data, but also on market sentiments. As a result, there are two paths in financial markets. Either you remain uneducated and become Soros's prey, or you learn and apply the common traits of the other investors and become wealthy. Patience and long-term thinking were the most distinctive common traits among these investors. As one master says, in every area where you cannot show patience, there is a place where you remain ignorant. To be patient, you must first understand what you are investing in. These legends excelled at market analysis. They deeply analyzed companies, their management strategies, openness to development, and growth potential. As a result, they invested in and became partners with companies they believed would succeed. When you master these qualities, market fluctuations won't bother you. Instead, you'll see them as an opportunity to increase the number of shares in your portfolio. These common traits will also turn you into a value investor.